And, people say, what's going to break? What's going to break? My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghost of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So there's a few charts. I think Claire's going to try and share them. Bond market liquidity is basically as bad as it was in the peak of the pandemic, when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now. It is completely decoupling from anything. And I'll come on to that in a sec. The next chart, another way of looking at it, is bond market volatility. Bond market volatility is higher than stock market volatility. Mm-hmm. This is not normal. And again, we're approaching the peak of the absolute crisis when the entire world shut down and we thought everybody was going to die, right? That's how bad the situation in the bond market is. What that's done is decoupled the bond market from the underlying inflation story. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. Okay, but the problem is if bond yields are going up and inflation expectations are going down, you see this next chart, Claire, which is real rates. Real rates have been trending lower over time. This is 5-year real rates. They trend lower because of debt and demographics. So you need to have low real rates to stimulate the economy or run it normally. So the trend rate of real rates is actually negative 1%. But we've just seen the fastest ever rise in real rates in history. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there. So it's creating chaos in the bond market because the Fed have essentially gone too far with this whole mechanism between how the banks can use their balance sheets, plus quantitative tightening, plus raising the Fed funds rate. And the market's freaking out. So it's decoupled from the fundamentals as well. So the bond market, Claire, if you bring up the next one, which is the ISM and the bond market are tied at the hip normally. Basically, bond yields go down when economic growth is falling because growth and inflation fall. And that's right. What's happened is bonds are pricing an ISM now in the 60s, high 60s, when the ISM in the next month is going to cross 50. So the ISM is going to be pointing to recession, which we all know is happening from almost every single guest we've had on. Yet the bond market is broken. So it's saying the opposite. Now, we've seen a few episodes similar, but this is the furthest it's ever been from the business cycle in bond market history. So it tells you there's a massive dislocation that's going on. That dislocation has spilled through to the currency market as well. We've already been noting, dollar yen, right? That was a specific situation because there was yield curve control, so you're printing yen. Then the UK. The UK starts cutting taxes whilst raising rates. And what happens is the currency collapsed. And today, the pound was down 3.5%. This is in the top 5 largest currencies in the world, and it's down and more volatile than the NASDAQ. This is extraordinary, but it's not just that. The Eurozone has got the same problems. South Korea, it's a mess. What we've got is a shortage of dollars, something I've talked a lot about, and many guests have talked about. There is a global shortage of dollars. The Fed are taking dollars out of the system, and what's happening is the safety valve is the US dollar is skyrocketing. Now, what that also does is export massive amounts of deflation. If you look at the nations who are suffering the most, it's the world's biggest finished goods exporters: China, Japan, Germany, South Korea, Taiwan. They're all seeing massive currency declines. So this is finished goods. This is TVs and computers and chips and all of that stuff. So the US kind of likes it. It also geopolitically, they like it because they exert their power, which is the biggest power they've got is the US dollar. 87% of world trade is in US dollars, even though the US is 25% of GDP. But you're choking the entire system. If we look at the next chart of Asian currencies, this is the ADXY, less looked at than the DXY. It's a basket of Asian currencies. That is breaking a head and shoulders top of a terrifying magnitude. I don't know what this is telling us, but it's telling us that there is no dollar liquidity in all of Asia. And this is a problem. It's a structural problem, not just a cyclical one that's happening now. So the moves that we're seeing in the bond market and the currency market are becoming sort of unprecedented, the sort of unprecedented we saw in March 2020. The knock-on effects are things like mortgage rates are exploding still. So it's having a real impact. This is not a financial thing. This is a real thing here. It's becoming an enormous problem for people. We're already seeing housing, house purchases coming down, prices coming down, rents coming down. We're going to start to see unemployment from the housing sector, which is a huge employer of average Americans, for example. Europe is in this huge grip that we know about. My working hypothesis, and oil broke today as well, which is something I've also been on here and talked about. My working hypothesis was I'm not sure the equity markets are going to make significant new lows, and I'm still not. They may break the low, go a bit lower, and then break back higher again, because the sentiment in equities is unparalleled. I'm about to write this in Global Macro Investor. It is the worst sentiment in any measure of any survey in the history of equity markets. So people are record bearish. They're terrified because of what's going on. The bond market, which is the anchor pricing for everything, is unhinged. And the dollar, which is the big daddy of all macro assets, has become untethered as well. So it is a scary situation. But how I look at this is, okay, and I had a great conversation that will come up in next week, I think, with Arthur Hayes from BitMEX. Arthur said, listen, there's 2 games at play here. One is those guys who want to be Volcker, and they're having their day in the sun. But in the background is a much more powerful group, and that is the politicians. The politicians are the ones that actually set policy. When the politicians decide that economic growth has gone too far, they will change the game. And I believe that. And that's where quantitative easing, direct handouts, and other stuff to alleviate the pain that's going on. They can't have mortgage rates like this for very long.